We are meeting in our third session for advanced business reporting, and I am sure, I think of course by looking at the views we can see a lot of students have been significantly benefited from this webinar series overall. So, I am insisting you, if you accidentally only look in this video, so don't look at this video without looking our first two sessions. Especially I spent a significant amount of time explaining the focus of advanced business reporting paper. So, when it comes to this paper, I even clarified why it is named as advanced business reporting rather than advanced financial reporting, right. So, essentially advanced financial reporting still is the main, I would say, core of this paper, which consists of 55% of direct learning outcome, but then there is a balance elements of governance which is 15%, and then there is an element of 25% called risk of material misstatement. So, some people probably, I am sure a lot of students sometimes narrowly view that there is an auditing part in this paper, and today in particular you will see it is not true, because this, of course, this is connecting to auditing, but the whole idea is, for example, when you one day become a chartered accountant, say you are a CFO, you need to really understand. For example, you may be responsible to prepare financial statements to provide true and fair view. So, we need to really deliberate, today we will do that, what is true and fair view or fair presentation. So, that has much to do with advanced financial reporting. So, therefore, today when I present this bigger part of the syllabus, 25% of coverage, you will essentially see the connection between financial reporting and auditing, and especially looking auditing from the perspective of an accountant or a reporting accountant, right. So, you are wearing the hat of a CFO and looking from the lens of auditor as to how financial statements can be materially misstated. So, therefore, when we learn this part, of course, you have to use the knowledge of accounting standards. A significant part of your syllabus entails dealing with interpretation of accounting standards and even consolidation, right. All these topics are highly connected to this 25%, and today you will see that connectivity, right. So, then you can see there is a 40% here, and there is another 5% coverage on ethics. That is why I said directly there is 55% focus on financial reporting, and then balance, and not only that, I think there is another topic called, I think it's part of this, non-financial reporting. In my first webinar, I explained the business language, for example, integrated thinking, integrated reporting. So, non-financial reporting is a huge subject that has gained a lot of momentum, right. Everybody is looking reporting from a different angle. So, future reporting is about integrated reporting, right. So, these are, I mean, I am not giving a long introduction today, but I just want to re-emphasize, reiterate the fact that you need to really understand the context of this subject, and I am sure this is going to be one of the challenging and most important subject at strategic level. So, basically by looking at the presentation, you will see what I am in this webinar series with me. There is another lecture I am sure that has already been published, another series of sessions which is connected to financial reporting is going on. So, similarly, I am covering today our third session. So, as far as this session is concerned, you can see there are 5 objectives. One is, because this is a huge syllabus, and when you get your study text, you will realize, I am sure, that is going to be much comprehensive to address both this financial reporting and auditing coverage. And so, basically these 5 items that you can see, the examinable topics, and then there's, I mean, I have always emphasized in my webinar series, 3 things are important for you to be successful in the exam. One is knowledge, right, and the other one is application, and finally what matters is what you write. So, this KAW really matters. So, knowledge, if you look at examiner, when examiner wants to test, always examiner may connect a question to a learning outcome. For example, there is a learning outcome called evaluate, right, risk of material misstatement. Then you cannot really answer this question if you don't know nuts and bolts of risk of material misstatement. It can be explained through inherent risk, it can be explained through inherent risk factors, and it connects to the concept of assertion, right? So you should be able to drill it to that level and to have conceptual clarity, then only you can actually understand how theories apply to the given case study. And again, what really matters very often in chartered accountancy, what we have seen in many subjects like this, right, auditing, governance, things like that, students terribly fail in the area of writing. Perhaps they simply reproduce knowledge without contextualizing, without applying them in context. So therefore, in this session, especially during this webinar series, you will gather a lot of knowledge in examinable areas. Unfortunately, very limited case studies I can do now, as you know, because this is a subject that has been changed after syllabus revision. And there is a change that was communicated, and therefore we see a delay in study text as well as revision kit. But I am sure when the even pilot paper, once the pilot paper is released, I am going to discuss with you that paper, especially the question that deals with this subject. So therefore, by looking at these objectives, we will talk about highly examinable topics. For example, if you look at my 2 webinars, huge content on corporate governance, but I really narrowed it down to some examinable topics like functions of board of directors, audit committee. You know, what is examinable? Corporate governance, different perspectives, theory and practices, all of that I just covered in 2 sessions. But if you really want to study them in much detail, we would have done 10 sessions. But then in the interest of time, especially as you know, this is a very different period we are operating. I think today is the only day that I came, you know, without still there is a curfew, we can go for official reason, but especially those webinars, series of webinars that were done during last 2 months, they were, you know, done with lot of restriction, but we were able to serve students. So I will also be covering study techniques, how to develop your own answers. Although revision kit or pilot papers are not available, I have constructed some case studies for you, so we will be taking those cases. And just to recap this coverage of syllabus that I already covered, you know, 45% coming from these 3 main topics. And one of the thing I mentioned to you in the previous lecture, I am sure most of the students would have been excited, that is this open book from auditing point of view, right? Are we able to take these books to the exam? And now Institute has clarified that you can go to the website. In the morning I downloaded this section, what are the permitted open books for SL1, and there you can see these. So let me to show them very clearly that in addition to accounting standards book, which is 2020, right, there is auditing standard 2020. But again, you may wonder, this is right now, I don't think the printed bound volume is available at the institute, because when I checked, it is going to come very soon. But again, the point for you is that once, I am sure it will be available during next couple of weeks, once the book is available, so please take a look. So don't, because one of the bigger reason in open book, with many years of experience I have seen, some students even in the exam, open book can be one of the reason for failure unless you use it strategically. So there is no way to read the books during the exam, especially if you look at this huge book on auditing. I mean, there is very little practical use you may make during the exam hall, unless prior to the exam you identify out of so many auditing standards, there are very few standards that may be relevant, that I can't say maybe, that is relevant, and you must know what are those standards, go through them in advance and to prepare. So that also I will cover today to a great extent. Otherwise, if you just look at all of these books, I don't know whether you can carry and how many kilograms of weight it is when you put all these books together. So what matters is, rather than book, your brain, how do you apply, you know, the knowledge practically to a case study and write your answer. But again, one of the benefit of open book, if there is no open book, students always struggle, do we need to memorize this, and it's very difficult. So that in that sense, open book makes life easier. So I don't just talk when I teach, and see there's a lot of effort behind this. Even last week I was supposed to do some lectures, but I didn't do because this is a new area. This is not auditing. This is a novel area that has been connected to financial reporting, and so there are, even I was preparing a lot of specific materials that you can use straight away by looking at this, because finally I told you in my previous webinar, if examiner wants to test something, the first document examiner should look at is the learning outcome, right? Because the idea of the exam is to cover those learning outcome. Now therefore in my session, after my session, if I don't cover any of the learning outcome, my lecture is to be, useless lecture. To be useful, I should be able to articulate the theory behind this learning outcome so that you can understand, apply them. So that's our purpose. So if you look at this 25% syllabus coverage, I would probably say in the exam you may get a case study, maybe 15 marks, 10 marks. These three learning outcomes which are in this slide going to be critical, right? So therefore in my first lecture today, I'll be taking you through this components of risk, right? So again I am reading with stress, because what I want to reiterate, this is not auditing. Now look at the learning outcome. Demonstrate the meaning and components of risk of misstatement in the context of financial reporting. It's not in the context of auditing, right? In financial reporting, how do you weave component of risk? But again, now to explain that, because end of the day, who is using this concept of risk of misstatement? Now if you are a CFO, you are going to get a shock when you see the audit report. In the audit report now, earlier auditors were, under very rare circumstances, I would say, right, because this is going to be very serious business for a company, to see a qualified audit report, right, or adverse audit report or a disclaimer. Now this is the earlier era, and today, because I said it's rare for somebody to say, for example, auditor may say that inventory is overstated materially as a result except for inventory financial statement present fairly, right? Okay, like that, if there is a material misstatement, so there may be a qualification. Adverse is a very serious case. But nowadays, there is auditors. Now with all this global crisis and corporate collapses, and a lot of people have challenged, and a lot of research being done, whether auditors' report is powerful enough to draw attention to high risk in a business. And that is the context of CAM. I am sure some of you may not know what the CAM is, and I am sure some of you will know, because you have, I am sure you should have studied auditing, right? Either KC4 in previous syllabus, or KB4, or even auditing under older syllabus. But again, under older syllabus you wouldn't have learned this, because this is a new concept. What is CAM? Key audit matter. The idea there is not really to say accounts are misstated, but to put business risk from audit perspective, because now today we will see the connection between business risk and audit risk, right? So I have several case studies in my presentation using actual Sri Lankan companies examples, right? So when there is a business risk, right, there are going to be an audit risk. And although accounts are not overstated, say if assets are not overstated, still auditor can highlight uncertainties, right? Especially when there is element of subjectivity, right, or significant judgment. So these are some of the very powerful words that you will learn in much detail today. Now what I am saying, in auditor's report, auditor is writing a paragraph about company's investment property valuation. This valuation has been done based on subjective assumption, and that has a greater chance of what? Estimation uncertainty. Now that is a key word. This is again not auditing word. EU, not European Union. Estimation uncertainty is a key word used in financial reporting. And I am telling you because there are a lot of research being done about role of accountants in future. So accountants are supposed to be navigators, integrated, and to have business acumen. So therefore financial reporting and auditing have been changed in that way. So as students of this subject, ABR, because you are going to master and to educate business community about art of reporting, business reporting. So in that context, you should be aware in 2020 there are a lot of changes that have happened in financial reporting, even in Sri Lanka. So one of the thing is, now if somebody asks, what is the base behind all accounting standards? What is the most powerful thing which we learned many years before, right? And although I am a chartered accountant, I really don't like to be engaged in preparing accounts. But I love areas like governance, auditing, challenging, judgment, things like that. Now if you look at base behind all the accounting standards, which I love, and any accounting issue you can address from this powerful tool. What is the most powerful tool or a magic behind, I don't know whether it's the right word, power behind accounting standards. So no accounting standard can violate this constitution. Now that's a good example, right? If you look at constitution of a country, that is the main platform behind any other law. Can government issue any law tomorrow which will violate the constitution, right? No. So like that, the constitution in accounting is called Conceptual Framework. And I am sure this is in your syllabus to be aware of what conceptual framework is, right? And this is connected to auditing. So I will explain to you how it connects. If you look at conceptual framework, it is very much connected to risk of material misstatement. So coming back to what I am trying to explain to you, right? When you look at your syllabus, you need to look at most of these concepts, especially risk of material misstatement from financial reporting perspective. So I am still on this learning outcome slide. Now in my first part of the presentation, still I would have spent now 15 minutes, right, giving you still an introduction to risk of material misstatement in general. But I am sure this board may be sufficient. I am going to paint a picture of this entire 25% in another 5 minutes, right? Before I do that, and I'm as all the webinars I did, even for different levels. So I am insisting, if you are watching this webinar now, pause it. If you don't have a book with you or some notes, you see, if you look at this syllabus, you will have maybe more than 1000 pages. Right, but I am telling you, when you are preparing for the exam, you can have a very small booklet which may have 40 pages, right, and where you can write most powerful points from which exam questions can be directed. So therefore, when I do lot of conceptualization to simplify very complex topics, like you can paint that picture in your mind, you don't need to open books in the exam. So therefore, I recommend you to have a book with you and write these notes with me and then prepare for the exam. And once the study text is available, please go through the relevant section, because I am going to give you a very powerful underpinning, right, which will help you to read any book or any standards in very simple way, right. So first part of our presentation, we will be talking, I am taking all these three together, and as I told you, if you learn these three together, right, misstatement, assertion, business risk, including fraud risk, you are equipped probably to handle a larger case study, right. In addition, there are other topics relating to RMM, which is not in this slide. For example, going concern, data analytics, fraud, even fraud is partly here. So, but this is, I would say, most critical part where exam question can come. Okay, we can start now. So I am gradually going to give a very specific introduction now. So the first point, I started with an auditor, and if you are a CFO, you are really worried when auditor is giving a bad opinion. So what is auditor's opinion? because we are looking auditing from finance perspective. So auditor is going to make a conclusion after doing a lot of hard work, right? Conclusion that financial statements are free of material misstatements. So I must write that. Financial statements are free of MM, right? MM is not somebody's name, right? No. Material misstatement. Again, there is a concept of materiality which you have to understand from the perspective of conceptual framework. Financial reporting, not auditing. Of course, there is auditing standard 320 of materiality. That is where auditors operationalize this concept. But now, for example, you have to explain to your finance director, you are a CFO, these auditors are going to qualify my set of accounts. You think, managing director in a private company. So managing director is going to get a shock. Qualified? We have never got that, right? And then, you know, are we going to get our bank loan, bank facilities extended, because banks will see that, you know, our accounts, you are cooking the books. So now, managing director is putting a lot of pressure to you to understand why auditors are doing this, because you are saying it's material. Then managing director is asking you, what do you mean by material, right? This is only 500,000, it's peanut. This is not material. Now that is where, if you are a very competent chartered accountant with a broad understanding of concepts behind this from financial reporting, not auditing, you will explain to managing director, this is what materiality. And I am telling you, after many years. So I have been teaching these subjects for more than 15 years, right? Even when I was a student, let's say 20 years or whatever years before, this materiality definition has not changed. But very recently, I saw last month or 2 months before, Institute is sending, I am sure you can also go through, there is a accounting and auditing standard committee in Sri Lanka, and there is a website, you can see all the changes, and usually these emails are sent out, and I saw materiality definition has changed internationally. Even conceptual framework has changed. So I am going to cover all those changes, and even in my presentation, why it was hard to prepare this, because this is based on 2020 auditing standard, right? So I have aligned this to the latest material, and therefore you will learn a lot of new things in this presentation, right? So, but I was explaining to you, another thing I should tell you, when I explain, although I go out of the subject, I am coming to the point. So you should be with me, right? So financial statements are free of material misstatement. This is what auditors say. Another famous word is true and fair view. What do you mean by that? Are there things which are true but not fair? Can there be things which are fair but untrue? No, it goes together. True and fair view equal to, or very similar to the, I mean, synonymous with free of material misstatement. Or another word is fair presentation. Now all these words you have to have a very good understanding. These are concept, fair presentation. Now I am asking you a challenging question, as I always say in this webinar series. If there is any students in this room, I would be happy to challenge them and ask, right? The question that, what do you mean by fair presentation? What do you mean by true and fair view, right? So when I teach, you know, in a larger classroom, I ask this question from several students. I hardly get an answer, proper answer from them, because they can't explain what is fair presentation, right? And I am telling you, this is not auditing. I will prove that, otherwise you will just think I am talking. Now this is how I prove that. Now I am referring not to auditing standard, but one of the most fundamental accounting standard, LK's 1. Of course, if I show this, you will see the answer, right? Then I will ask that question back from you. I am going to give, but you know, I am going to give answer from accounting standard, which is LK's 1, right? So what is fair presentation? The answer is, if financial statements have been prepared based on applicable financial reporting framework. This is not AFR, applicable financial reporting framework in accordance with underlining, right, definition of elements of financial statements and relevant accounting standard. Let us say, put it very simple, whether accounts have been prepared based on SLFRS, then the resultant set of accounts deliver meaning attached to fair presentation. So in other words, right, now here whole idea is about material misstatement. If somebody wants to know, my previous simple example, stock is overstated, right. So what is the definition of overstated? We cannot explain this overstatement without connecting this to L case, right. So L case 3, right, dealing with inventory says inventory has to be valued at cost or NRV, whichever is lower. Now this is a case where a company has not provided for slow moving stocks. This accounting standard has not been applied, therefore it results in a misstatement. This is a very simple example. If you look at a revenue recognition practice of a construction company, right, while they sell land and do partial completion, they recognize the full price. Now you would challenge this in terms of SLFRS 15, right, new standards, 5 steps revenue recognition, right, the performance obligation has not been discharged, the control has not been passed, how can you recognize the revenue? So there is in the balance sheet website development cost which is capitalized as an asset, or customer list has been capitalized as an asset, or pharmaceutical companies doing a new drugs for coronavirus spend millions of money and they have capitalized. So can we treat this as an asset? According to conceptual framework, this is not an asset, right? And also according to L case 38, which clarifies what is an internally generated intangible asset, this is not an asset, therefore it is misstated. You can apply any accounting standards, right, and to relevant to the scenario and identify misstatement. So my first point today, that is why you can see these two subjects are married together now, the accounting and auditing, right. So if anybody wants to identify whether there is a misstatement, that is why auditor is using accounting standard as the criteria to provide an assurance, right. So with that, I am sure now you know the point that I was trying to explain, and I will show all this definition after my all the introduction. I am carefully going through slides where you can make notes, right. Now this is all introduction and to awaken your thinking, right, of the practical application of this subject. So because I explained to you material misstatement which auditor is using to form an opinion, before I start, I should give you a perspective too, because if you look at your syllabus, you have to demonstrate some understanding about auditing standard, because you are looking auditing from accounting perspective, right. So therefore, at the start I want to start with this. Like conceptual framework, of course for auditors also there is a framework which we call assurance framework, but beyond the assurance framework there is very fundamental auditing standard. We would say this is the mother standards of all auditing standard. So what is the end objective of auditing, which I now explain to you, giving you example. The managing director was worried about auditor's opinion. That is, now I am talking to you about Sri Lanka Auditing Standard 200 that explain objective of an independent audit and need to conduct audit in accordance with in accordance with Sri Lanka Auditing Standard, right. But we don't need a whole lot of details about it, but I want to drive some key points from this. One, what is the main objective of auditor is to provide a report with a conclusion stating whether financial statements are free of material misstatement. This is the end objective. Therefore, if you look at the process of auditing, first of all, if you want to give an unbiased opinion, the auditor has to be impartial, unbiased, independent, and that is what we called, that is what is governed by ethics. So, you are also going to learn some of those ethics in this subject, I am sure already you have. And then once you have an independent auditor, then the next task of auditor is to comply with all auditing standard. Comply with all relevant auditing standard, right? For example, there may be about 30 odd auditing standard. Every standard has to be followed. When auditors follow standards, right, auditor is gathering, but you cannot give an opinion without what? It's not gossip, it's not just information, but we called evidence. You cannot give opinion without evidence. So, evidence gathering process is driven by standards. So, these are evidence, we use the word sufficient, appropriate evidence, right. So, sufficiency is about the quantity and appropriateness of audit evidence is about the quality, whether audit is gathering right evidence. In my simple example, inventory is overstated, right. So, relevant evidence means evidence auditor should have gathered pertains to valuation. Valuation is an assertion. So, evidence should be relevant to the assertion, right, and evidence should be reliable. Now, I use the word assertion, you may not know what it is, it is a syllabus topic, one of the very important topic you will learn in a little while. And then this is the purpose. And throughout the process of auditing, there are two pervasive concepts. One is brilliant mindset of an auditor, that's why, that's the uniqueness of chartered accountants, right. Any students who are going to be chartered accountants, they are expected to get this training from audit or commercial sector, especially those who are trained as auditors in the corporate world. You see, they are going to be very different. If you do a research in Sri Lanka, you will find that CEOs, managing directors, even I have personally heard some, business leaders talking about chartered accountants, the value they create. One of the fundamental reasons, I would probably say, of course I am not telling from a research finding, but I would probably say one can do a research and prove this point, hypothesis, right, that this is the brilliant qualification of audit. It's not a paper qualification, right, it's called, and when you become CFO in the commercial sector, this is going to be one of the very powerful thing. That is why all directors are looking up to you, help us, we need your opinion, right. Two things, these both things are very important. One is questioning mindset, that's called skepticism, professional skepticism, having a probe in mind. Can this happen? How can this happen in this way? This is not possible, challenging, right. So, professional skepticism means a probing mindset, questioning mindset where you recognize accounts can be misstated. It's not to have, preconceived view that this is always wrong, but to be open-minded. The other important, most power, we are talking about accountants' job going to be taken by artificial intelligence, RPA, all of that, IoT concepts, but this one, robots will find very difficult to master this. That is one of the brilliant, I would say, skill that an accountant will develop. So, auditor is using that is called professional judgment. And the whole process of financial reporting also involves professional judgment. So, there is a challenge between auditors' judgments and accountants' judgment. There can be a debate. That is where misstatements can be analyzed. Today we will discuss all of this judgment. This is very important. This is more from auditing point of view. What I explained to you in this, if I summarize, I would say this is the foundation standard of auditing, where it says auditor has to give end objective on the top an opinion that contains, financial statements are free of material misstatement. That is your syllabus topic, 25%, right. So, then how audit is going to do this? By applying standards, and through the application of standards, audit is gathering evidence. So, because I spoke about evidence, right, I shall tell you there are two things auditor will look at. One is the process where auditor get to know which balances in your account sets are more subjective or susceptible to risk. For example, cash balance relatively risk is low compared to investment property valuation, which is fair value risk is very high. So auditor will initially identify risk. There is a process of risk identification in auditing that starts with auditor's understanding of the business, right? After this understanding about 5-6 areas of the business, industry, right, about the nature of the entity, about the accounting policies, about the KPIs of the business, about the internal control framework, audit is going to have some idea about certain inherent risk in the business. I haven't yet explained to you inherent risk in detail. For example, you will see fair valuation of investment property inherently entails a risk. Inherently it is a risk whether control is there or not. Why? Valuation of investment property involves subjective assumption and judgment, right? Based on this judgment, answer may be different. And if management wants to be biased, now note this word management bias, very important word. Management can be biased by changing discounting rate by 2%, the valuation is going to be changed by millions. All of these I will show you case studies in my presentation in a little while. What my point to you, when auditor is looking evidence, auditor is first going to look at where the risk is, and then if the risk is in investment property valuation, auditor will audit that through further audit procedures. So we call in auditing RAP and FAP. RAP means risk identification procedures, and I am sure if you are going to be an accountant one day, this thought process of how to identify risk really matters. And then this is for auditors. You all are not, all of you are not going to be auditors, but good to be mindful as to how auditors look at it. So that's called further audit procedure. So what I did now during last 10 minutes to explain to you the audit perspective. Now let's get into financial reporting perspective. Yeah, I think before I go to my much comprehensive analysis of risk of misstatement, I should now give you some knowledge. I should now explain to you, or I should allow you to read some of the fundamental accounting concepts that is relevant to our discussion, because in my presentation I am referring to most of these words. You see, that's another thing in the exam or when you study, there is a vocabulary that you have to use. Vocabulary bhashava, vachanamalaava, right? What is this bhashava, right? So for example, we will use the term assertion, we will use the term estimation uncertainty, right? Likewise, there are various terms. So therefore, I want to touch upon them from accounting perspectives. Now let's take through this. I'll take you through this, some of these key concepts, and then we will go to much detailed explanation of much detailed explanation. So I want you to look at this slide, just read it out. So I will stop for 30 seconds and see whether you understand. Don't forget, this is from LKS 1. Right, so what do you see there? Financial statement shall present fairly. See that word? You can highlight, right? So you wrote already this word. Present fairly, three things. Financial position, balance sheet. Financial performance, that's the P&L or income statement or statement of comprehensive income, cash flow. Then it says, fair presentation requires faithful representation. That's the key concept. So I want you to note that word. Please write it down in your piece of paper. Faithful representation of the effects of transaction, other events and condition in accordance with definition, recognition criteria of asset, liability, income, expenses set out in the framework. What do you mean by the framework? And that is what I said, you know, whole theory behind accounting standards. See these words, definition. Can you value human resources in balance sheet? Have you seen, for example, somebody so and so has been valued and put in the balance sheet? No, probably human resource may not still meet the definition of an asset according to conceptual framework, right? So first thing, to give fair presentation, there cannot be any asset in the balance sheet which does not meet the definition of an asset. There cannot be any liability. Now if I ask you, there is one company shown in the balance sheet, right, expected cost of restructuring, refurbishment cost, refurbishment of plant refurbishment cost. Now can this be a liability? This is shown as a liability provision, expected cost of refurbishment. You know, any brilliant student in terms of concepts will say, now this is termed as a provision. Provision is a liability, and liability is a present obligation. There is no obligation for the company to refurbish, it cannot be a provision. You know, without even reading the accounting standard, you are answering by knowing the definition of a liability, right? So therefore it's very powerful, that fair presentation. First point, conceptual framework. The second point, you apply the relevant SLFRS. So in my example of that provision, you apply SLFRS 37 on provision and even the disclosure, and say when you apply both framework, see what I am putting is a very simple formula. Fair presentation equal what? Remember, fair presentation is your syllabus topic. That's called risk of material misstatement. Equal what? This is more or less similar to what? Applying what? Conceptual framework. When you say conceptual framework, especially definition and recognition, right? And even disclosure. So definition, when I say definition, there are in the accounts, if I ask you how many things, there are only 5 things, right? Asset, liability, equity. There are no 4th thing in the balance sheet. Asset, liability, equity, and then income and expenses. This is all you have in financial statements, right? And then definition and recognition. Plus, this is broadly for all the assets and liabilities and equity, income, expenses, plus the applicable SLFRS. If you are talking about share-based payment has to be valued at fair value of share option at the grant date, not any other date, only at the fair value. That's the prescription given in SLFRS. If auditor wants to audit, if auditor doesn't know this, auditor will never find a misstatement. So that's the power of accounting, right? So that's the first thing I want to note. I hope you understood this. The next question is, okay, if I put this in a, okay, I'll cover this concept as well before I give you an example from this. This is another important slide. Again, I want you to take a look at. So there are 2 framework for finance, because I said fair presentation equal to this. In other words, I can combine this and say fair presentation is a result of applying relevant, right? What is the word used in standard very often is applicable financial FRF. When I write FRF, it doesn't mean something else but financial reporting framework. So that framework broadly consists of both conceptual framework as well as all the standards and any other laws that can affect, you know, financial reporting could come under this. That's the framework. So in Sri Lanka, what's the framework we follow? If somebody asks, in Sri Lanka, do we have a fair presentation framework for preparing accounts? Yes, that is SLFRS. SLFRS, we can probably say, is a fair presentation framework. But if somebody asks, can we prepare financial statement based on Inland Revenue Act? Can, but it is not fair presentation framework. It is called a compliance framework. So this is another thing that you can learn, another learning outcome, right? compliance framework versus fair presentation framework. What is the difference? That difference is very, very important, and again it's coming from LKS 1. So why we use the term fair presentation? Wherever possible, always you comply, right? Comply is very important, but sometimes you go beyond. For example, company likes to disclose beyond what is in the standard as long as it is relevant, right? This relevant is a very important one, because at the end of the day every information is given for decision making purpose, right? So company can disclose beyond accounting standard, fair presentation allows it, and in extremely rare cases company may deviate. I use the word extremely rare circumstances, company may deviate. So that's why we use the word fair, because you are also allowed to deviate and go beyond as long as it is fair. Therefore it's fair presentation. But when it comes to compliance framework, you cannot go beyond, you are not supposed, and you are not going to deviate. So now read this definition carefully. Right, so these are very important thing, right? Usually we also have the term general purpose framework. General, now this is from as you see, these are there in auditing standard as well as accounting standard, right? So general purpose framework is a framework that is, general accounts available to any user, wide range of users. But if I am given a set of accounts to inland revenue, right, based on the tax law, it is called compliance framework, right? So fair presentation means, I said two things. One, compliance, and acknowledge that to achieve fair presentation, management may provide, see this word, beyond, disclosure beyond the requirement. And also you acknowledge explicitly that management may deviate from the framework to achieve true and fair presentation, right? Now this is different from compliance framework, where compliance is mandatory. Like you prepare, if you want to prepare a set of accounts based on an agreement or based on an inland revenue act, from auditing point of view we call special purpose framework, but those are compliance framework, those two examples, right? Now you have an idea as to how material misstatement can come, right? So, but to give a more another solid definition from auditing perspective, this is another auditing standard where I am still explaining to you the meaning of fair presentation, right? And when in auditing context, as you know, we call this, if there is a gap between these two, that's the risk of misstatement, right? Or let's assume it's material, then we call risk of material misstatement. So when you look at in that way, right, when company prepares their account, we say this is company's accounting policy. We'll take a very simple example. Company's accounting policy is to charge all interest cost to P&L. This is company's policy. But remember, when company's policy deviates from SLFRS, it's called misstatement. When company's policy deviates from SLFRS, is called misstatement, and there are three types of misstatements. Some misstatements are factual, that you know for a fact there is a loan which is 100 million purely for construction at the rate of 1%, and this entire amount has been spent to build the construction. Therefore, this interest component of 10 million need to be capitalized as a part of borrowing cost. If company has not done that, it's factually wrong. It's called factual misstatement. The other one we call judgmental misstatement. Now these are very important terms, please make a note. Types of misstatement, right? Types of misstatement. From where this comes, if you want the standard, like I said, we are using here, right? We are giving even for chartered accountants who are going to be CFOs or accountants. We call accountants in business. We are giving them the auditing framework to critically look at the accounts, understand whether in your accounts can there be a misstatement, if so what it is. Factual means factual. I took this example, say borrowing cost not capitalized, so factually it's a problem. The other one is judgmental. That is where there is a difference of opinion in how auditor looks at and how managers looks at in terms of areas that involve judgment. So the best example I can give, and today in my presentation there are a lot of actual example I have taken, estimates. Now in the morning so when I say in the morning, you are doing this presentation in the morning. So when I say estimates, I used the example earlier called fair valuation of investment property. Now if you look at, I have example in my presentation how fair valuation is done and what are the valuation models. Again, that's the accounting standard, right? When you say fair valuation, all accounting, right? So auditors are borrowing from accounting, isn't it? Yeah, because without SLFRS, no audit of financial statement, because that's the criteria. Right, but you can audit anything, but when there is no criteria, how to audit? So there is a SLFRS 13 on fair valuation, right? Level 1, 2, 3, all of that. So there are different valuation approaches, valuation models, data, etc. But if you want to value an investment property using, let's say, income approach, where you take the cash flow and discount it, and discounting rate is changed from 10% to 9% without any basis, and audit is challenging this 9%. This cannot be 9% because this is not the relevant discounting rate, and that is a difference in judgment. So therefore, that can still lead to a misstatement. The third one is called, this is again purely from auditing angle, projected misstatements, where auditor will observe an error which is very consistently to be expected. For example, there is a system error in sales. Auditor has checked 100 invoices, right, with a value of say 10 million, and in this 10 million there is an error, right? There is an error of let's say 10,000. So then in a sample of 10 million, I am giving a very simple example, right? In a sample of 10 million, there is error of 10,000 and your total sales is, let's say 500 million, right? So then you kind of project the sample misstatement to the untested population, right? So that's the idea. So what did I explain to you now? Always I ask this question after giving lot of explanation, come back now and ask, what did you learn? Right, you learn now what is a material misstatement. So this is the definition. Everything which I explain and I write sometimes in a way you can't read. That is why all what is in the board I have taken to the PowerPoint slide where you can slowly read. Now this definition of misstatement, read it carefully. A difference between reported, there are three things: amount, classification or presentation, right? A difference between reported amount or a disclosure, so to speak, right? A difference between what are the two? One is reported. So I want to highlight the word reported. So there is a difference between what is reported and what should be reported based on the framework. Now in my previous example, borrowing cost all classified to P&L or reported in the P&L, right? But actually it should be capitalized. So that's totally the entire amount comes as a difference as far as asset value is concerned, right? Because asset value to be increased by 10 million and now it is not increased, therefore misstatement is 10 million, right? So that's the idea. Then before I get into the heart of my session today, because I spoke about these words, fair presentation, materiality, and words like estimation, uncertainty, faithful representation, all these words are from conceptual framework. So I will, because this is a pure accounting topic, the conceptual framework, but I am taking you through these slides because these are, if you are a good advanced financial reporting students, if you don't have this basis, right, basic knowledge, I am sure you are not going to be a very sound accountant, because the conceptual framework has the power to analyze any scenario, right, and give an answer. So basically in the conceptual framework, it talks about one of the main criteria which they call permissive criteria is why information is for decision making. If you want to make a decision, you have to give the relevant information as well as we would say fair information. That's the whole concept of faithful representation. So our definition of risk of misstatement mostly deals with here faithful representation. While you give relevant information, which I am not explaining you now very well, but there is one part I must explain to you, materiality. But anyway, for your usefulness, of course you should know when you say relevant information, we are looking, information should have some predictive value. Using this information, I am going to value this company. Valuation represent future cash flow potential, right? Ability to generate cash in future, predictive value of information. When it comes to last year, right, I predicted next year revenue, and when it comes to that year 2021, I can compare, and then that shows the confirmatory value, right, and then materiality, which we will discuss today. So relevant has those three, and when it comes to faithful representation, we are looking at information has to be complete, and when it comes to risk of misstatement, this we look at this as assertion, completeness. I will explain to you that you cannot miss anything which is important. You cannot drop some of the say liabilities. You cannot have off balance sheet liabilities if it meets the liability definition. The information has to be neutral. Now some people ask, now there is a concept called prudence. Is it there in accounting standard anymore? Yes, prudent has been connected to neutrality, right? So you have to be neutral. In other words, there cannot be management bias in reporting. And also you see this word free of errors. That is again connected to misstatements, right? So these, if I take them in detail, relevance, right, you can see relevance, information is relevant if it is capable of making a difference in the decision making, right. So relevant information can make a change in the decision making, and faithful representation is about the substance of whether information report the substance, the economic reality, and then it is also meant to be complete information, neutral and free from errors, and it is, see this word which I mentioned to you, faithful representation can be affected by measurement uncertainty. So remember this word measurement uncertainty, especially we use this for accounting estimates like fair valuation, right. So then, so one of the key change in this framework is that they reintroduce prudence, right, and define measurement uncertainty, which is a very important one for auditing, and neutrality is supported by, so whole idea of prudence is to exercise caution when you are making a judgment under condition of uncertainty. So in other words, in risk of misstatements, we will talk about fair valuation of say equity instruments, fair valuation of derivatives. Now these are done under uncertain condition. Now if you remember, one of the great example I can give you, very recently Institute issued a guideline accounting under pandemic scenario. You know, there can be companies where under this pandemic situation that they will see their fair valuation, right. Now you are using for example, if you apply SLFRS 13, there is a fair value hierarchy. So level 1 is to use quoted price from active market. Now what is the active market? Now there is lot of news, if you look at internationally, share market was affected, because when there is no volume of transaction, share price will significantly drop, and if you happen to use that value and value your investment, so it will drastically drop. To avoid that, you know, they gave some guidelines, you know, you can use a valuation model. Now when you use that valuation model, right, which may be some, say for example you can use dividend growth model and do a equity calculation and a valuation using some assumption, right, but in those assumptions you know very well that if you change the discounting rates, some of the growth rate, the answer will be changed. So that's a big point for this syllabus topic, right. Especially we call this estimation uncertainty, and their company should be prudent. Prudent means exercise of caution when making judgment under condition of uncertainty. So, what is measurement uncertainty? That we will discuss especially on auditing. When there is a measurement uncertainty, true and fair view can be affected. So, today I have lot of example for you, and don't think that this is now, some of you will now think, oh, this looks like a boring session with lot of theory. No. You have to be patient in this lecture also, because in another half an hour time you will see lot of practical application in Sri Lanka, practically what companies are doing, practically how auditors are looking, how accountants should look at, right. But without good theoretical underpinning, I mean, just discussing on the surface that's not the way I want to do this, right. So, I am still on the conceptual framework, but these are for extra knowledge. Because I spoke about it, you need to be aware that you cannot have any asset in the balance sheet which does not meet the definition of asset. Of course, asset definition has now changed in 2020 conceptual framework. I am sure it is applicable maybe from 2019 or 18, you can check the date. But the new definition, there is a change. So, what is an asset? A present economic resource, see the word controlled by the entity, then they have defined what is economic resource. It is about right that has the potential to produce economic benefits. Now, best example to take, most of the operating leases like right to use a land which were not on the balance sheet, now on the balance sheet. Why? It is an economic resource where a company has the right to use the land during next 20 years to earn money. So, therefore, it is on the balance sheet. See, that is how there is a leasing standard which is aligned to this definition. That is how you have to interpret. Likewise, liability I spoke about today, a present obligation. There is no practical ability to avoid. Now, take my previous example. If you were with me in previous half an hour, right, I said there is a liability called provision, expected refurbishment cost of a plant. Now, if I am the owner, that company, so I can avoid this year, I do not have money, I can postpone this refurbishment to next year. So, I have the practical ability to avoid, it is not a liability then. That is how you have to look at. The equity is the residual interest. Likewise, I think I have come to that concepts from accounting angle I have given to you. So, now we are looking from auditor's lens, right, but still from the perspective of accountant. Right, the risk of misstatement. So, I think now we have come to that point. Yeah, so yes, now we will. So, this is where I said I am going to do a very detailed conceptualization, which all of you should be ready to now. When I say all of you, you are watching this individually, right? You should be, let us say you should be able to. or you should now start with me painting this big picture of risk of misstatement. As far as your syllabus is concerned, this picture will cover, some bigger topics like risk of misstatement and some auditing standards. Also, another topic called internal control frameworks, and which we will discuss today at a later part of the lecture. So, all of that you should be able to see in few minutes. And as I told you, I will also take you through some case studies to apply this knowledge that we discuss. I really insist because I am looking the size of this board. This is going to be very long analysis. So, therefore, better I recommend you don't just watch this, right. If you are traveling and watching, of course, you can't do. Please with me draw this. So, you will learn a lot. Logically connecting accounting to auditing to control to all of that in one analysis, right. So, we are starting with what? Our subject is financial statements, right. Our subject is financial statements, and as you know, there are 5 things in set of accounts. There cannot be 6 things, right, because that is what the Constitution says. What are the 5 things? Asset, liability, equity, income and expenses. So this is, as you know, this set of accounts has to be prepared based on what? Based on FRF. What is FRF? Financial Reporting Framework. And you already know it includes Conceptual Framework as well as relevant SLFRs and perhaps relevant laws may be. Right. So, this is a set of accounts, right. The other thing, if you want to put this in a more in another manner, if this is your balance sheet, right, you will see there are balances, account balances, right. There are three things that matters for all these five. There are three things that matters for all these five. So, there are account balances and there are classes of transaction. That is the word that we use usually. It is a class sometimes together, classes of transactions. So, sometimes I will miss, there can be some misspellings, I write very faster, so apology. Class, account balances, transaction and disclosure. So, these three things are relevant because there can be a misstatement in all of these. For example, disclosure may be omitted or may not be there, right. Now, to analyze all of this, right, in terms of risk of material misstatement, right, we use this very powerful framework which is in auditing, in particular called assertion, right. So, I will write here assertion, and this is one main thing that you must learn in this lecture, and to be very powerful with this knowledge I will give you several examples to understand. So, all that assertion I also put several coins, otherwise you very difficult to remember all of this, right. So, I use this word pack cover, which will cover all the assertions. It cover all the assertions. So, for the time being you will wonder what is pack cover, right. So, it is about presentation, accuracy, completeness, cutoff, occurrence, valuation, existence, right, and obligation. Let us say you do not know, but I spoke about fair valuation of investment properties, it properly valued. Then we spoke about completeness, all the sales that should be recorded have actually been recorded. Occurrence means you cannot report a sale if it has not taken place. What is taken place? If your company is shipping goods, exporting, what is the point of occurrence? Apply SLFRS 15 to underline economic transaction. Although you hand over your goods to forwarder, you cannot recognize revenue in terms of SLFRS 15. You have to see at what point control will pass. Then recognize revenue at that point. If that point has not reached, performance obligation has not been discharged, the sale has not occurred. But I will take that example more clearly in a little while. So, I just gave a quick explanation, right. So, using this pack cover, we can actually discover what? Risk of material misstatement. So, I will further break this down to elements and explain to you, right. So, before I break it down, right, so I must tell you that this process of now how do you prepare a set of accounts? Let me to put a box around this financial statements and probably say that. So, what is this box? And to coin that, you can't, for you to prepare financial information, this can be sometimes a smaller company or a bigger company, right. So, what is in red, I term this as information system. Very important, note these elements, right. So, I think I will write those component in red. So, there are 5 red things I am going to write. This is one such thing, and putting together it's a very big thing. So, I will tell you in a little while what it is. Then the other thing that I want to explain to you in the process of preparing financial statements, what can go wrong, broadly what can go wrong, right? So I am using this circle to put broadly what can go wrong, broadly, and write in here something risk. Now see, I am again talking about risk, but these risks are cannot be identified saying this is a revenue risk or risk with investment property, but this is a big risk. You are going to audit a very unusual company. You don't know what is going to be wrong. A deadly company. Why? That company is run by one-man show and there are a lot of legal cases. Everybody is questioning this management honesty of this company. If you have factors, beyond the accounts, look at the big picture. That's why some auditors get lost. They audit a lot of transaction invoices, but they don't audit the people, heart. What do you mean by auditing heart, right? Now, see, auditing, the beauty of that is even auditors are supposed to evaluate management integrity. Now, see, I am writing here, management integrity. If there is no integrity, you are going to, you look at some of the companies even in Sri Lanka. There are so many cases, right, globally, Enron, WorldCom, all of that, Satyam, right. See, these companies, chairman or CEO, somebody will decide we need to, cook the books and increase our revenue, right, increase our profit, like WorldCom did. WorldCom telco company decided, okay, we want to increase our profitability, charge some of the capital expenses, revenue expenses to, capitalize them. Right, management integrity. And in these companies where there is a lot of powerful individual, they bypass existing control and try to pressurize and for example, this is a bank, there is a credit control, so managing director is passing a lot of money, taking a lot of money from the bank for his own companies, right. So this is where senior management bypass existing control framework, right, which we called a management override of control. That's a very big word in auditing in particular. So please note that word carefully, management bypass control, management override of controls, right. Now, in the process of preparing financial statements, auditor will see some of these risks. I'll put another one. You are auditing, it's a bank, like I said, very complex transaction, derivatives, equity valuations, all of that, but there is no qualified accountant. Even the finance director is not qualified. Now, these are some of the intangibles. I am not talking about the trial balance. I am talking about the management honesty, and this is a part of honesty where you are going to respect the control, right? Or you can bypass, or you are not spending money to have qualified accountant. There is some problem. So these are called again risk of misstatement. So I will write in this corner, risk of misstatement. We can always break the first bigger element of risk. This is like iceberg, right? So iceberg, what is in the iceberg, this is the invisible part, right? What is visible is this. It may be your assertion level risk. Assertion means you exactly know inventory valuation, know sales completeness, so whatever something is wrong, but why it is happening is mostly because in iceberg what is hidden is a big part. So these are what? Financial statement level risk. Now you learn a big topic here, right? So now I also recommend you, while you draw this, you go to another page and write. Now one thing that you learn now, there is a risk called financial statement level risk. So please write with me. Now I am also expecting you to write down. So what is financial statement level risk? Those risks which are pervasive. I write the word pervasive. Pervasive means it can affect many areas. Those risks that are pervasive and potentially affect many areas in financial statements, right? When we say many areas, many assertion, many areas of financial statement. For example, if you are in a company where there is a high management, high level of financial statement risk, the reason is their control environment is weak. That's another thing I want to explain to you where the control environment comes. When we complete this diagram, you will see that. So now see, I told something called control environment, right? So there are 5 things I will write here. So in red color, this information system is one. The biggest thing out of all 5 is the control environment, right? So I haven't explained to you this yet, but what I am trying to tell now, one risk in accounts is this hidden risk, financial statement risk, which is mostly coming from, you see my first 2 webinars focus on corporate governance. Corporate governance is much connected to control environment. Whether leaders, business leaders, directors, are they honest? Are they truthful? Are they really accountable to shareholders, right? So this risk is called financial statement level risk. You can't exactly identify at assertion level, right? So now I am taking these one risk out right now. See, this risk of misstatement we can break into 2 components. One is inherent risk. So I am looking how the size inherent risk, whether I will have enough space to write. So I think I will put it in this, because inherent risk is the most important one where I want to talk a lot of things, right. So I think I will take risk of misstatement to this, so that I have space to write. Risk of misstatement we break into 2, right. So one is inherent risk. So please make a note, this is a very important concept that you will learn now, inherent risk. So other one is called control risk. Inherent risk and control risk. And then when it comes to inherent risk, I am again drawing a circle, right, and this circle is partly broken somewhere, right. You can see like this, and I am also showing, you know, this is going to be broken, and therefore it is opening up to this control risk, right. So this, if you see, this is this area has to be protected, but it is broken. I know you didn't understand, but be patient, I will explain to you. So when it comes to inherent risk, right, I am writing another thing in red color. I said I will write 5 things in red color. This is one thing called risk assessment. And remember, what those 5 things are not auditors thing. These 5 things are relating to any company, and company is supposed to have these 5 elements, right. So that is risk assessment, and this risk assessment can be done using IRF framework. What is IRF? Inherent risk factors. So please write it down, otherwise you will wonder what IRF. Like I said, all the slides I will show you in a little while. So inherent risk factors, and especially in new standards, now of course while this is there in a company, relevant to a company, this is covered in auditing standards. So remember, one of the most important auditing standard which I am covering in this diagram is Auditors risk standard, which the standard was changed in applicable from 2020, I think. It is there in your new book, 350. So understanding the entity and assessing the risk of misstatement, that's the main standard, where in your 25% of your syllabus is predominantly reflected, right. So now there are under this inherent risk factors. Again, for you to remember, I could put this 2C, right, or you can say 2 cums. That means I am writing 2 C's, and I said 2 cums, right, UMS. What is this? You will wonder what this is. So basically there are 1, 2, 3, 4, 5 elements, right, that can result in inherent risk. So this is a wonderful framework. So let's see what are those 5 tucums, right? What are tucums means 2 C's and U and M and S, right? So the first one is called complexity. All the practical example I will show you in a little while. Complexity, right? The other C is change. You see, life is always changing. No, we never thought that we have to be at home for 2 months and this corona will happen in this way. In risk management, it's called black swan. You know, all swans white. No, this is black swan event. You never anticipated, but it happened. Change bring lot of changes. Change bring lot of risk. Complexity, change. The other big thing is uncertainty. Now, one big uncertainty that we learn is, you remember estimation uncertainty, which we covered. So then there is M, and M refers to, that is a deadly one, right? That is where, when this complexity, uncertainty, everything can be misused to improve profitability, and that I am writing in a different color also, that's management bias. Then there is S here, and S again, because of S the management can be biased as well, therefore I am also writing that in the same color, subjectivity. So this is a new framework. Even I read this during last week, it's brand new and the standard was very recently introduced. But anyway, for the exam purpose, when I say introduced, the standard was revised. But for you, for the exam purpose, you know, when a new standard is announced and after some period, 6 months, is applicable for the exam. But forget those things, this framework definitely. What matters when I do past papers, pilot paper, case studies, you will realize that these thinking framework really helps you to write answers, right? So this is inherent risk. If you look at set of accounts, at assertion level, we have to see, can there be an inherent risk in terms of complexity which will affect the completeness of revenue? So we cannot now learn anything without explaining the term assertion. So now I will, before I draw any further thing, otherwise you will be confused, I am drawing so many things, I will stop now and explain to you what is the inherent risk definition, and if we don't learn this definition, we cannot proceed further. Now, what is inherent risk? Without using different example, I will use the same example that I mentioned today. Investment property fair valuation. So, the best example I can cite is the tallest building in Sri Lanka. So, what is the tallest building in Sri Lanka? World Trade Center. What is the company? Overseas Reality. It's a listed company, right? Now, imagine that building we have to value using fair value model. Now when it comes to valuation, which is a fantastic subject governed by SLFRS 13, there is a definition of fair value and there are various valuation approaches, especially if you ask, see, like chartered accountancy, valuation is a profession, right? For example, we say there are, but like financial reporting standard, there are international valuation standards and there are professional valuers. They use, fundamentally there are 3 approaches broadly, right? But if you read Conceptual Framework, there are more than 3, right? Cost approach, income approach, market approach. Now see, market approach is where even in SLFRS 13, they say level 1 valuation, take the value from active market. Now, is there active markets where the properties like World Trade Center is sold and can we capture the price? No. So now, when there is no active market, we may have to use the income approach. The income approach is to look at, okay, this World Trade Center I have to value now. How do I know how to value? I will look at the value of something is the cash flow potential. How much can I earn during the future? So I look at the future, right? Let's say for the future period, the cash flow that I can derive, the net cash flow, and then I will discount. Now, are you going to use treasury bond rate? Totally wrong. This discounting rate has to represent the risk profile of a company which is in property business, right? So, now that is a very complex exercise. You have, say for example, in Colombo, in that area, what is the rent per square foot? Now that one, is if they propose some figure, you have to see, okay, is it correct? Is it comparable? Right? And then based on that, okay, you have X number of square foot value, And then the challenging thing is you have to look at the cost as well to derive the net cash flow and discount it. One of the very sensitive, and this rent is going to grow in future. This growth factor is another big question. Discounting rate is a big question. Now these are significant assumptions that can lead to what is the name. See, I am reiterating a lot of concepts which I already spoke so that you remember them. That's called estimation uncertainty, right? So there is estimation uncertainty. I am telling now you investment property inherent risk, which is valuation assertion, is high primarily due to uncertainty, subjectivity and management bias. This can be answered in the exam paper, because estimation of fair valuation involves subjectivity, uncertainty, complexity and may be misstated by management. That's the answer I am writing in exam question if balance sheet has investment property. You see how theory was converted to answer, right? So that is what we are going to do now, to look at inherent risk definition and to learn assertion before we proceed further. So I will show you the definition. Before I show, I will read the definition for you. Inherent risk means risk that an assertion can be misstated. See, the definition starts with assertion, which means valuation can be misstated. Risk that an assertion can be misstated, assuming that there is no control. Which means, now see, the circle that I draw here represent control. But I draw it because I want to explain control risk also, but usually when you assess inherent risk, this circle is not there. What is the inherent risk, right? But if you want to look at risk by taking control into account, that's your combined risk assessment. That leads to control risk, right? So control risk again can be high or low based on two important things that matters when you evaluate control. I will come to that point. So we are now at the definition. So let's read the definition. Now I am giving you time. All what I now see, I am talking. If you miss something, I am showing you carefully the slide. Look at it. Inherent risk definition. So please take a look at this now. Right. Now when you look at the slide, see this word susceptibility means possibility, right? Possibility, see the word assertion. Now nobody will understand this if you don't know assertion. That's why I said after this we have to look at assertion. Anyway, right now I gave you example. Assertion, valuation is assertion, completeness of sale is assertion, right? So when it comes to any account balance or transaction, we explain assertion. You can, for the simplicity, say assertions are the qualities of account balances, but that's not the proper definition. I'll explain to you. Assertion means features, characteristics, right, that you will audit, let's say, but it's not the proper definition. I'll come to that. But take the example of investment property valuation, that is an assertion. Possibility that an assertion, it may be a transaction balance or a disclosure, could be material individually or together before considering control. It's very simple. If you put this definition in very simple language, inherent risk means, right, what is the possibility where any assertion could be misstated if you assume control is not there. Out of all diseases, right, why corona has the highest inherent risk? That's a good way to understand differently, right? Whether you wear a mask or whether you touch your nose or not relevant. The corona is deadly for the reason sometimes you without symptoms, it's called asymptomatic. Without symptoms, so there can be a suspected case. Symptoms are not shown, inherent risk is very high, right? So even though you bring some controls, it fails. Because even when I walk into the institute, they check the temperature. I forgot to bring my mask, right? Now there are control measures, but sometimes those symptoms are not shown. So then how can you control? So inherent risk is, for example, if control environment is weak, there are one-man show, frauds, all of that. And this company has a lot of complex transaction, there can be control, but without control, whether they are there or not, you have a high inherent risk. Control will help you to narrow it down to some level, right. So actually in that sense, you see this is the size of my first circle. After, if controls are to be effective, your combined risk to be reduced, right. So anyway, I read the definition of inherent risk. So what is the definition? In short, assertion can be misstated. And then I said we can't learn this further if you don't know assertion. Now let's learn assertion. Please write the in your book or note assertion, right. Now that's the most important thing. I think I may have the definition, so I may I think I would have, that slide is not there, but doesn't matter, I can explain to you. So please write down. Assertion means, right, this is how it is defined. First of all, literary, dictionary meaning, if you look up the dictionary for assertion, what you get is, assert means the term assert. I assert, there is something wrong and he is not right. That's only assertion. I am not 100% conclusive of what I say. It's assertion. Assertion, when you look at the dictionary, the meaning is declare something to be true. It's a declaration, we don't know whether it is truth or not. So similarly, when a set of accounts are produced, assertion means, please write, representation by management which are implicit or explicit embodied in financial statements. Did you understand representation? Now I am sure you didn't understand that definition. Representation by management, implicit or explicit, which is inherited in the process of accounting. Okay, put it in simple term. We said representation. When a company say our sale, this is the same, I will use the same example, then life becomes easier. This example I cited about 1 hour before. I am sure now I would have taken about 1.5 hours. Am I correct, Suraj? Right. So let's say there is a sale of 100 million. Now this is an export company. Say they manufacture something and export. And I mentioned to you in the morning, SLFRS, so I am referring to morning because you are doing in the morning, SLFRS 15, I mentioned to you about an hour before, about SLFRS 15, right. There is a 5-step process. You see, the beauty of this subject is you are learning this anyway under accounting standard, right, because you can't pass this subject if you don't know. This is one of the fundamental standard, SLFRS 15, 5 steps, right. Now you have to apply this 5-step process to this and to see whether there is a misstatement, right. Now this company sale reported is 100 million. I said assertion means representation by management. Now what are the representation when they say 100 million? They say we have counted all the shipments that went, completed, all the transactions that should be recorded have actually been recorded. That's called completeness. What is completeness in sale? Transaction that should be recorded have actually been recorded. If somebody wants to say completeness, can you get a list of invoices and check invoices? List from the ledger and tick off the invoices? You will not audit the completeness. So you will not, audit is not the right word, we are looking from accounting angle, right. You will not establish the control as a CFO. Now what is completeness? You may, now completeness, you may want to check my all invoices are supported with what? Dispatch note. To say that in 5-step process, my performance obligation, I have few slides to demonstrate, when we discuss this, it comes to revenue recognition, the 5-step process, right. So out of 5 steps, identifying the contracts, so like that there are steps, and most crucial step is at what point performance obligation is discharged, meaning at what point control has been passed, and only at that point I can say revenue has recorded. Now even for completeness, I have list of invoices. Let's say I have 1000 invoices all these 1000 invoices I should be able to trace dispatch note, right? If I have dispatch note more than 1000 which is not captured here, my sale is not completed. So that is completeness. When they say 100 million, all sales have been completed and we have reported in the right period. So that period is called cutoff. You see, this is one is cutoff, right? And this one is completeness, which I explained to you. Cutoff means the right period. Now, I think if I am explaining cutoff, right? See, this whole discussion of assertion, like I explained to you from the beginning, all inherent risk, everything when it comes to misstatement, it goes back to the SLFRS 15 and then ask the question, can we recognize the revenue, right? Now, so I will straight, now see, I have done a presentation which has so many slides, so many topics, and the flow actually emerge as we discuss. So I will go to straight SLFRS 15 to, I don't know whether you have properly studied, to you know, check your understanding and then explain the scenario more from a financial reporting perspective. Yeah, now see this one, right? Now see, we can't talk about revenue recognition if you don't know rules of the game. What is the rule of the game? SLFRS, right? Can I close this?
Close.
Right. See, one of the core principles in revenue recognition is recognize revenue to depict transfer of promised goods or services to customer in the amounts that reflect the consideration to which entity expects to be entitled. So that's a broader statement, but if you really look at these 5 steps, one is, I know my customer is in US or Europe, and my performance obligation is to deliver, right, the items that we have produced in manufactured in Sri Lanka, right? Let's say you are a manufacturing company, you have manufactured, let's say, some items for the export purpose. Let's say this is a business of doing apparel, footwear or whatever, right? So now you have produced that, and then step 2 is, if I got an order, my duty is to deliver this. Performance obligation is delivery. I have a price for that, right? Because now when I say this, price is obvious in this case, right? But if you look at in some cases, price is bundled. You know, the product is bundled together. You have the initially there is a price for the connection as well as the phone device. Then you have to split the price, transaction price. That's the 4th step. You have to allocate transaction price to different performance obligation. Take example, a car manufacturer sell the car giving 20, 50 free services, right? Or services at a reduced cost or free maintenance or something like that. Now when you do that, you may have to allocate your price that you obtain and split it into 2. So your contract, so I said free services, let's say sometimes you bundle in the, although you say free, you have embedded some price, then you have to split it and take as 2 performance obligation. One part you can recognize actually when you do the services. So today you can't recognize everything. So anyway, I am not covering the standard in much detail, right? Your financial reporting lecturers will cover this in very much detail, but I want to get it at one point, how this connects to risk of misstatement, right? So the most important point in that sense is, have we satisfied the performance obligation? So what is really performance obligation, right? So now one of the important thing here, step 5 is control, right? Now earlier standard talk about risk and rewards, and now one of the key change in this standard, if you come back to my example, I said we have shipped these goods So the question is, at what point the control over goods are going from buyer to seller. So we have to establish that point. So only at that point revenue can be recognized. Practically this can be at a point or over a period. You know, when I say over a period, sometimes you do a lot of construction which take time. Over a period you recognize revenue, as long as the customer can use those goods or services that have been produced, right, or customer has some control, things like that. So now this is very simply I explained to you step 5. Now coming back to my example, now I am actually looking assertion called occurrence and cutoff, right. Now please, now see what we are learning now, assertion. I hope you wrote in a book Completeness. Another thing I want to tell you, don't wait till the study pack, you can now go to Google, search 315 standard, read it, assertion, you can read all this definition what I am referring to. That is the open book, and other beauties you can take this book to the exam, but you do not need to really worry about that. So now assertion I explained to you up to now. Completeness means all transaction that should be recorded have actually been reported. Transaction is reported in the right period. Now this is what I want to explain now. This export company, right, they manufactured some good on the year end is 31st March. 30th March 2020, this is the period of corona period, right, 31st March 2020, they have a shipment to go, right. Now this is the company, and company hand over this to a shipping agent, right, and you know, in Sri Lanka most of the shipments will go to cargo village. Let us say this is going to cargo village and your shipment is landed here, and then from cargo village another forwarder takes this to airport. You know, even some shipments are going even this period, right. Let us say this is to be shipped, and after handing over, at this point there is a bill of lading raised. So bill of lading is the document to say the goods are on the vessel and ready to go, and cargo village will issue some say forward, so sometimes they call say FCR, some document, full cargo receipt, some document, right. Shipping agent also can give some document saying that dispatch acknowledgement or dispatch note. From company's gate these goods are going, gate we raise a dispatch note. What I am trying to say, according to standard, revenue should be recorded at the point where control has passed. Now imagine these goods which were delivered on 30th May, there is a fire at the cargo village and goods were fully destroyed. Who is responsible? Is company. Who is at loss? Who will lose the good? Is the company, or can company still recover money from the customer saying that I have handed over goods to cargo village? The answer depends on, that is why in 5-step process, read the contract. Identify the contract. Contract is a 4B contract. The Incoterms, you can Google what Incoterms means. Incoterms means international commercial terms. Incoterms FOB means, right, the right or the control over goods will pass only when the goods are on the board at the vessel. If I don't want to draw a vessel, goods should be here, then only control. Now meaning, if this is a FOB contract, the fact, although you have handed over to a forwarder or anybody, still you can't record the revenue because the control has not really been passed when you analyze the terms of the contract. So that is where, when it comes to risk, now what I want to explain to you now, the occurrence assertion. See, now I will read occurrence and the cutoff. I am explaining two assertions from this case study, this illustration. Can I recognize the vessel sailed? Now there is another date called in the bill of lading date, right, which is 5th April. Now this sale is a big amount, say about 10 million, right, dollars. Export company, I said, say, can I record this delivery that went on 5th April in my 31st March accounts, 31st March? The answer can be no. right, because it can lead to a misstatement, and that 10 million may be material if it will affect the decision, economic decision that you are going to make from the profit. And why it is misstatement, especially this we are talking about two assertion now, occurrence and existence. Please write, because I already told you completeness means all transaction that should be recorded have actually been reported. Cutoff means transactions events are recorded in the correct period. Occurrence means, write it, reported transactions have actually occurred and relevant to the company. Reported transaction, now in my case 100 million include 10 million, but can I say this has actually occurred, because bill of lading is not raised. So therefore reported transaction has not occurred. Therefore occurrence is not satisfied. When there is no transaction in the P&L, right, you see assertion in P&L and balance sheet. When there is occurrence of sale, there are going to be a debtor in existence in the balance sheet. Existence is not living, but there is actual balance, right? And from that debtor I have the right to collect the money, but both existence and rights are not established now. So we say if it is asset, right, if it is a liability, there should be obligation. Normally we say RO, right? Now did you understand? So what I explained to you now, occurrence assertion, right? Occurrence means reported transactions have occurred and relevant or pertains to the entity, right? At the same time existence means assets reported actually exist. So in this case there is no sale, accordingly there is no debtor, and accordingly there is no right. These assertions are not met, therefore there is a misstatement, right? So that is the understanding. So I think with that understanding, if you look at this assertion slide again, now you can easily understand the balance assertion, because I have explained to you some of the difficult assertion, right? So occurrence, sale occurred, right, and then there should be a debtor in the balance sheet, and then at the same time there is a right for an asset. Similarly, right, when you get your electricity bill which has not been accounted, you may have to provide, or you have a contractual obligation to provide for somebody, right, because it's a contractual you have agreed, then there is an obligation in the balance sheet. So you can't book. If you look at one of the example I gave you today, can you make a provision for expected refurbishment costs? No, there is no obligation. Balance cannot be there as a liability. And we discussed valuation of investment property. Valuation assertion means a balance, especially this is applicable for balance, right, has been valued based on the relevant SLFRSs. Right, so existence means assets, liability actually exists. So these assertions, existence, right, valuation, these are applicable for balances in particular, and presentation is applicable for both, classification for both. And these assertions, occurrence, completeness, occurrence, accuracy, cutoff only for transaction, and completeness is applicable for both transactions. This is a key topic in your exam, right, assertion. So that's why I took a simple example and sale and explain. Let me to extend the same example. You remember we haven't finished our diagram, so we were explaining inherent risk definition. Now in this company which I explained to you, do you think there is a very high inherent risk, very high? Now risk of misstatement means, now I may have to erase some of this so that you can clearly see. So what I explained to you, inherent risk has risk of misstatement has two components. One is inherent risk, the other one is control risk, right? Inherent risk and control risk. So let's do this. See, this revised standard says companies or auditors, because I am telling this originally, this is a tool used by auditor, right? But that tool, understanding that when it comes to account set, because if you are a CFO accountant, your account set are to be audited, and understanding how accounts can go wrong is important. So therefore remember, this is a separate evaluation. Inherent risk evaluation is separate evaluation, control risk is a separate evaluation, and then finally we can actually combine and see what is the combined risk. Now take my same example, right? Now where do I put inherent risk of revenue recognition in this company? If I tell that same export company, they have, now I am giving this like exam question, right? This is an export company, right, that has different customers in Europe, China, US, and the contract, type of contracts with the customer varies, and based on the contract, company has to change the revenue recognition. Now if that is the explanation, I am writing an answer in the exam. See, I am a student, by reading the question I am writing answer. Revenue recognition, there is an inherent risk because of complexity. Now see, I underline the word complexity. Why it is complex? There are different types of contract. Revenue recognition point, the point at which control is passed changes based on the contract. So therefore, you will see inherent risk is high. So the next thing, if you are a CFO, if there is a complexity and high inherent risk, put a control around it. So what is the control? You want finance manager to establish, right, few control. One is review contract. These are management control, right? Management will review each type of contract and identify the point of recognition and relevant document, right, and then at the end of the period they run a dispatch invoice report which has a dispatch detail. Now this, as you know, dispatch detail is not enough. We should know whether goods have been handed over. If it is a FOB contract, right, the relevant date is bill of lading. Now I will say shipping details. In shipping detail you can have forwarder handover detail. I wrote FHW, forwarder handover, FHO, handover dates, or say bill of lading dates. Both are there. If the contract is FOB, this is the date for revenue recognition. Now there are other type of contract like FCA. You can Google if you want to study this further. FCA doesn't mean fellow chartered accountant. Here FCA means a contract. FOB is a contract. FCA usually at the time of handover you can probably recognize the revenue. So my point to you, at the month end, right, you have already identified, now this is a control, internal controls, right. So this is, let's say, what shall we say, this is a reconciliation. So there is a reconciliation between invoices, dispatch details, and the same reconciliation provides shipping status. By looking at this report, there is a tick, revenue recognized or not. You know, this can be sometimes automated, it can be manual thing. So control can be automated or manual. You know, that leads to another point which I should explain to you. Right now, I think I can write that now. This, after explaining this control, I will write here the types of controls, right. So this is a control. Let's say I am terming this as a reconciliation control, right. So the reconciliation has to be reviewed by somebody. Now imagine if this reconciliation is properly happening, inherent risk is high but internal control is sound, therefore you can say inherent risk is reduced through the control. But the issue is we have to assess whether control can fail or not. I am erasing that, but this is a very good example. Please write the example if you want to write before I erase. There is export company that has different customer profiles. Point of revenue recognition depends on the point of based on the shipping terms, and at the month end company is preparing a reconciliation report that has invoice, dispatch details and shipping details, and then by looking at that the revenue recognition is determined. So that's the control, right? If that control is happening properly, all the sales should be right, no? Occurrence is okay, cutoff is okay, even completeness may be okay, right? If this is covering all the transaction, we have to see. If some transactions are missing, it will not cover. Now, using the same example, I want to illustrate what is meant by control risk. Okay, so if you remember my diagram, I have to reconstruct it as I erase. So this one, control risk, right? This is where I said, now this inherent risk, there is a circle represents the control, right? And that is where I want to write, now if this circle represents control, so I want to write some of the control here. So example of control I will write in few minutes. Okay, I will use a different color for this control. What I want to show here, although there is a control, there is a chance that control breaks. So that is the size of control risk. So we need to really see when the control is broken, right? The control is there, but sometimes it breaks. So why control is not there, that risk is called control risk. Control risk means risk that at assertion level, the control may not be able to prevent, detect and correct misstatements. So it is due to a design issue of a control or due to an implementation issue, or operating effectiveness is not good. So these three words are important, right? So I will show you this definition as well. When you look at the slide, the definition page, control risk. A risk that misstatement could occur again assertion. Our assertion is revenue occurrence and cutoff, right? Our control is the reconciliation of shipment and dispatch, but although this control is there, control may fail to prevent, detect, correct. So I am also giving you the reason why control may fail. These are the reasons. One is, by design, this report is a manual report. This report has missed several invoices. So by design, system control is faulty, flow, right? And then although report is there, no one has checked the report. Control has not been implemented. Although implemented, some months it is not being checked. So it is not operating effectively. So therefore control can be fail due to a design. Now these are very important terms. Please write. Design means, design of a control means control should be capable of, right, dealing with the misstatement or reducing the misstatement. So ability of a control to minimize the risk is design. Implementation means whether design control actually exists, right, and companies using that control, called implementation. Operating effectiveness means throughout the period whether control is working. Now this report we said is manual and there are errors and it is not checked sometimes, right? Therefore we conclude control is not good, therefore there is a risk. So there is an inherent risk is high, there is a control risk is high, therefore combined risk of material misstatement is high. So what are the assertion? Now this is how practically, if even I can write an answer from this. So practically we are looking now two things, revenue in balance P&L and receivable in balance sheet. The assertion which we have covered through our example for transaction, we have covered for revenue occurrence assertion and cutoff assertion. And if transactions have not occurred and if you are recording debtors, this is debtors, right? There is a question about existence of debtors, right? So these are the risks that you will identify, right? So there is a control, but we have evaluated control also and identify both inherent risk is high, control risk also high, then combined RMM is high. So therefore in your company revenue there can be issues. So that's how you interpret inherent risk. So because I spoke about control, taking an example like reconciliation, let me, if you remember 1 hour before, more than 1 hour, I said I will write 5 things in red color, right? and in that I have already written one thing here, information system, another thing here, risk assessment, and that is what we now completed. For the revenue, we have company has identified revenue as a high risk transaction and identified inherent risk as high and control risk also as high using IRF framework. So IRF means CCUMS, as well as assessing control risk separately. Combined risk assessment has been done, and after the risk assessment we have identified that these assertions are at high risk. So what are the assertions? In our example, occurrence and cutoff as well as existence. So this is the problem. Now the problem in the accounts going to be the problem. So therefore, I explained to you risk assessment part separately, no? So then another thing that I explained to you, when there is a risk, company will implement control activities. So that is this circle, control activities, right? So I think, let me write now that in red. That is the next third thing I said, out of the 5 things. Now you will wonder, now what are those 5 things? Those 5 refers to is a big point, internal control framework, right? So I have put number 2 here, right? And number 1 I explained to you, but I haven't still drawn number 1. So if this is number 2, this is number 3, control activities, right? So now I want to give you some example of control activities. I will use blue color and write this example for control activities. You can write it. So usually there are different types of control activities. One, authorization. Now for example, all sales are authorized and approved. Sometimes some of these approval are system driven, right? So sales manager or director has to approve sales. So maybe when it comes to EDI, it's automatically approved and go into the system, right? So authorization and approval is a control. Then the reconciliation is a control. So what I am writing outside the circle are controls. So this is one reconciliation control. And then I would say most powerful control out of, this is more fundamental for all the control. Without proper segregation of duties, all control can potentially fail because people can get together and bypass, so misuse. So this idea of segregation of duty is to see especially conflicting tasks and make sure it is done by 2 people. For example, the one who is invoicing is not the one collecting cash or dealing with cash, right, or doing the bank reconciliation. If something has gone wrong, say you are receiving the money and misusing, so that is why there is a separate person doing the bank rec, separate person doing the invoice, and at the time of invoicing there is invoicing clerk is applying the money received and setting off invoices. But if you get everybody to do one person doing that, that person can do some money without setting off against the invoice can be taken out through another account and pay to a supplier. You are applying cash and pay to a supplier, and that supplier is one of your friend. When I say you, the person, take money out. So I am writing example for control activities: authorization and approval, reconciliation control, segregation of duty. 4th example, physical control. Right, and then then there is a bigger one, biggest control, because most of the things in today's world happening through IT. So those controls are called information processing. That's a separate topic I want to discuss. So under information processing, both IT general control environment and application control really matters. So I may have to touch this maybe in another session, but it's another big topic where IT comes. For example, in your invoicing system, access to database has not been controlled, backups are not taken. Those are IT general matters. IT application means every time when a new invoice comes, credit check is automatically happening, is called IT application control. So have a good understanding about IT control. If someone has changed the system program, so that's the general control failure, right? So now this is the control activities, the third one. right. So, I have explained to you control risk as well. Now, to complete this analysis, right, what next? So, I have to now explain to you the most important aspect of the this. I said I will write 5 things. Now, I have now written up to say there is one control activity risk assessment. So, what is the most fundamental thing for this entire framework to work, and that is here, and I already touched when I explained to you about half an hour before. I said most dangerous risks like iceberg, some risks are seen, but what is hidden is things like management integrity, whether management is bypassing, whether there is a good governance, and all that put in together, that set out the foundation for the control system, and that foundation is called what? So, I want you to guess or think what it is, and let me to draw that here and then put it. So, how can I draw that? How can I plug that into my conceptualization is something like this. So, I'm drawing another kind of box, rectangles type of things which will cover this whole thing, right? And this is FRF. So, this one, see this whole, it covers, it's all, it's very much what? All encompassing thing, right? So, where should I write that name? I think better I should write on the top. So, that is all encompassing, right? So, that is called control environment. So, please write. So, the first foundational element of internal control system which mainly influences financial statement level risk is called control environment. From the exam point of view, this is a very important one, and in your revised standard 315 they have actually done some change to control environment elements, and I put in this terms for you to remember control environment. So, I will come to that. So, I can actually coin a term so that you can remember these new ones. I will explain to you what this is meant, GACA, right, and you need to really understand what it is. So, but before that, forget all of these terms, words, but practically what does it mean to you when we say control environment? What does it come to your mind? So, the point that I previously mentioned, iceberg, you know, this company seems to be very good, you know, they have computers, softwares, everything, but you know what is going on is dangerous. You know, the way the board is handling things, CEO is very powerful, sometimes directors don't challenge the CEO, CFO, they are doing, you know, double books and lot of issues, directors are like sleeping, a total governance failure, lot of people doing unethical thing, the culture is in questionable, and a lot of good people are leaving the company has failed to attract talents, right? So, all of them. Now, what's this? Governance, right? And people are not taking ownership, accountability, and then the like I said, company's ability to attract people, the culture, right? So, all that is questionable, right? So, these elements, so indirectly control environment means what? It is the foundation for internal control system. It refers to the awareness, attitude and action of the board. How serious board about the internal control system. But practically you should be able to measure it. So, that is why we have this element. So, I think I should show this to you and illustrate. So, again this slide is going to be very useful. Right. So, I think when I put this slide, you will also see all 5 elements, I think yeah, so I have to explain one more thing, but let's we can still put that down. Right, see, one of the things that you will come across in your syllabus is the Conceptual Framework, right. Now, as you can see, I haven't covered all of these 17, you can see there are 17 points here, but I have been explaining to you certain element called risk assessment and the control activities, the information system, and I touch upon control environment now, right. So, basically the purpose of control environment is, now you can read here, now this is straight away taken from Conceptual Framework, these 17 points. But for the purpose of exam, I also mentioned to you there is auditing standard number 315 which is recently revised. So, that I put 5 words called GACA, right. So, I want you to write those 5, and also after writing that we will compare how it stands against the this 5 principles. They are actually pretty much the same, very similar, right. So, what I meant here, okay, let us first of all read these 5, right. Now, what you see here, if it is a company, you can have, you know, system, people, whatever. When you look at the control, internal control system, most intangible element which drives the control behavior is the control environment. So, there number 1 is whether at a board level are they committed to drive a culture. That is why under my term GACA I added the word C, it is the word culture which is there in the standard as well. Culture where they promote integrity and ethical values. So, I do not need to over explain this, you can listen to my corporate governance 2 webinar on the same syllabus topic, where I mention despite control how companies like Enron, WorldCom and even some of the Sri Lankan companies that I mentioned, because of these unethical practices at board level, you know, you can have sophisticated reconciliation, but at senior level they can decide to do anything, right. So, under GACA I put this under C, then I term second point as governance, right. So, when we say governance, we are looking about in the company that you are looking, do you have good governance, and according to this it is about independent board of directors, oversight, etc., right. But in terms of your standard, I will write it here, governance means there are 3 specific things that is mentioned in the standard, and I want to write it and explain to you the 3 pieces that comes under governance, right. But broadly, now you see this is one of the very important point. Good corporate governance means good control environment, good control environment. Now, this is a very big formula that you are now seeing, right. So, the governance first. Good corporate governance drives a good risk management system, and that in turn drives a good internal control environment, especially control activities. So, meaning control risk can be reduced to a great extent when there is good governance. So, the most pervasive element of internal control system is control environment, and remember practically when control environment is weak, we will learn in our next lesson the fraud risk is going to be very high. If there is an exam question asking what is even is there in your syllabus, what is the connection between corporate governance and internal control system, the idea is when there is good corporate governance, now I can write these 3 words. I said there are 3 things in the new standard. One is, right, whether governance, especially this governance means we use this term in auditing standard TCWG, you can write it, those charged with governance, right, are they independent, so are they separate, first point, are they separate, are they independent, right, and do they exercise oversight. So, these 3 features even in exam case study you have to look at, but then no point of just writing words if you do not understand. Separate means That's what we discuss in corporate governance, the separation between governance and management, and this is where there are non-executive directors. There are things like audit committees separate to management, they will challenge the management. And then there are independent directors. So the governance or those directors, they will independently question CFOs with the help of independent internal audit, for example, right? And then they will exercise oversight. Oversight means every month, every quarter accounts have been really scrutinized, checked, questions have been asked, very tough question by audit committee or independent director. So there, that company auditors are comfortable. Even as a CFO, you are very happy because you know there is an independent separate oversight which will help you to ensure accounts are correct. So that's the governance piece of control environment. I am referring especially these terms GACA, I coined the word GACA. This is coming from the new standards, and this C refers to, like I said, culture, right? I can do a separate session on culture, integrity and ethics, right? Because that's the most important intangible elements that drives, you know, the health of the organization. The iceberg, I said, if culture is poor, a lot of things can happen. And there is an interesting term coined by a famous person called broken window theory, right? So what broken window theory means, right, say in your house, when one window is broken in your house or in building, a window is broken, nobody takes care of it. The idea, message is, if one window is broken, nobody takes it seriously, the chance that all other windows can be broken is very high, which means it is a company, lot of unethical things they accept. Now, best case study today in the actual business world is Volkswagen. So Volkswagen has been charged for installing defeat devices in thousands of defeat devices in vehicles. Even books and case studies have been published. You know, that is not one individual, it can be a part of entire culture. So what I wanted to tell you is that this broken window theory, right, there can be another company, even one window is broken, immediately it's fixed, and those who broke can be sacked from the company. We are very serious. So that's the power of culture, integrity and ethics, right? So likewise, those companies with good internal control environment, they attract, because without talent is very important, you have to have very good qualified, experienced CFO, especially if you are talking about financial statements. So attract right people, developed and retain them, right? And then overall, people should take accountability, take responsibility for internal controls, right? So those are some of the very important elements of control environment. And then when you look at this one, right, here as well, so very similar one. I'm taking you through Conceptual Framework. There are 5 elements and I put those 5. So for example, here integrity and ethics, I explained to you independence, board of directors, and independence of board of directors oversight. I covered this under 3 points. And then structure. So this is where the organization structure comes. So organization structure, especially it talks about assignment. When you look at your auditing standard, you will see this point differently, but it's the same thing, assignment of authority and responsibility. Now, if there is a company, especially this affects segregation of duties without a clear structure, and there is no clarity of reporting style, reporting lines, so a lot of things can go wrong. Then the accountability, right? So these are directly relating to control environment, which is one main part of like foundation of those 5 elements. Now, if you count these 5 elements, so there has to be a good foundation element called control environment, Number two, how company is going to identify inherent risk factors. To reduce those inherent risk factors, are they having good controls? And then all these controls are happening within the environment of information system. So that is the fourth element. So then I said, when I started this diagram, I said I will write 5 things in red. So what is the fifth thing which I write on the bottom, which is called monitoring. So remember, monitoring has 2 elements I will explain to you, right? One is ongoing monitoring, other one is separate evaluation, right? So what is really monitoring in an organization? Okay, you are thinking you have good governance, audit committee, outside directors, hiring right people, they are responsible. You have a good IT systems, you are assuming that system has control, and you have various authorization, reconciliation, segregation and so on, and you are assuming that risk have been identified. But how do you know this entire system works? Is there assurance that all these elements are working, whether the IT system is properly working? Are there unethical practices? Who can provide that independent perspective? Checking whether all controls are working is monitoring, and usually internal auditors play a big role to check on a going basis. Oh, by going basis means every month some of these control backups have been taken, whether duties are segregated, there is a check being done on a regular basis. That check in to see whether control has actually been working, and then separately you can do a comprehensive exercise on entire IT system, separate internal audit for example to see whether ITs are working. That's monitoring. Now by connecting this much bigger picture which is here, what I was trying to explain to you, the whole concept of see, as a matter of concluding on this, I think we have taken about 2 hours now. Oh, exceed 2 hours and 20. Yeah, so if I continue this lecture, I can continue for another 2 hours. Those who watch, will struggle, but I will therefore come to some conclusion now, so that we can logically connect this lecture to with our next lecture, right? Which I will separately, I will break it at a point, at a very logical point, so that we can move on to much complex area. But remember, if that is the sense, this 2 hour plus lecture gives you a bigger foundation into this 15% syllabus topic called what? Risk of material misstatement. So what I covered, I explained to you totally from financial reporting perspective, about half an hour out of this 2 hour and 20 minutes, taking what is conceptual framework, what is faithful representation, what is a misstatement, how SLFRSs are connected to a misstatement. Then during balance 1 hour, I took time to explain to you, right, the whole picture of financial statements, how misstatement can happen, right? Now these are very important, my conclusive remarks. Now you check your notebook to see what you have learned now. What you have learned during this 2 hour session. Number 1, you identified the concept of RMM, and there are risk of material misstatement has 2 components, right? It can happen in 2 ways. One is assertion level risk. Now if you haven't written, please write. One is called assertion level risk. The other one is called, see what is this box I wrote somewhere, this one is financial statement level risk, right? That is the iceberg which I drew and explained to you. So financial statement level risk, you have written in your notebook saying that those risks are more pervasive and can affect many assertions. So example, management integrity issue and management override of controls and question relating to management competence, right? So that is learning 1, right? So assertion level risk and financial statement level risk, learning 1. So the next bigger learning point for you is inherent risk assessment process. Inherent risk assessment used in IRA framework, right? So how to identify in a given scenario 2 CUMs, right? 2C and CUMs, right? The complexity, change, uncertainty, and and what is management bias and subjectivity using this framework. How now probably in my next lecture I have to touch upon, right, in many business, through a case study we will touch in many business complexity, uncertainty, right, change comes because of business risk. So I think this is a separate learning outcome in the syllabus. I can probably start my next lecture with business risk and the financial statement risk interaction. So our second learning point was to identify inherent risk factors, and as a separate learning point I would say how to identify misstatement using assertion pack cover, right. That is our third learning for today, this webinar, right, this session. Then the fourth point that we discussed was through a case study, how do we connect controls, internal controls, to reduce inherent risk and also identify internal control failures. That is our third point, right, fourth point. Then finally the biggest point that you learned was 5 elements of internal control framework, right, 5 elements of internal control framework, right. I think that can be a point where I should finish this lecture. I am not finishing, I need another 5 minutes to explain these 5 elements of internal controls through the COSO framework. And so out of those 5 elements we discuss control environment using these elements, governance, these 5 elements which I showed in the slide as well, control environment, then the risk assessment, and when there is a risk company will have control, and these are the types of control like authorization, reconciliation, segregation, physical control, and then company's information system is critical, right, company's information system is critical to ensure that there are to ensure financial statements are reliable. I think because I may have to explain this also in little detail, I will take, because I already touched these 5 elements, but together holistic picture of internal control also I will club into my next lecture, and to show COSO framework again and to move on to case studies using this knowledge. I think that with that we can conclude this session. And I am sure together with this session, if you learn the next one, you can apply most of these things in practice, and to learn in the exam how do you use accounting standards knowledge to identify risk of misstatement, especially using assertion as well as financial statement risk. Thank you.